Welcome and thank you for joining our webinar today. I'm Jyoti from My Time Equity, and we are delighted to have you with us today. Joining us today are Sudhir Pai and Anup Nayak from My Time Equity. Before we begin, I would like to take a moment to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIF firm, My Time Equity takes pride in being your dedicated partner on this financial journey, helping you to plan, grow, and preserve your wealth with confidence. Sudhir Pai is a founding principal of the firm and serves as a fiduciary investment advisor representative, bringing deep expertise in wealth management and tax-efficient investing. Before I hand over to Sudhir, let's take a quick look at the disclosure slide that our attorneys require us to present before each session. We also request you to scan the QR code to join our My Time Equity WhatsApp community to get exclusive updates on equity markets, alternative investments, real estate, crypto, ventures, and many more. If you have any questions during the webinar, please type them into the Q&A box and we'll be happy to address them during the discussion. If you like to connect with us or Sudhir after the session, you can reach us at wealth@mytimeequity.com or call us at 972-330-2771. Anup, I'm handing over to you.
Thanks, Jyoti, and very good morning to all. Before Sudhir speaks about the regular update on the markets and the offerings that we have got, I just wanted to take a moment to let everybody know in this call that we have had successful calling of the following notes in the recent past. So when we say successful calling of the notes, if you see the first one, for example, this was an income note that was issued on in December 2024, and it was called a week ago, which means that the client who had invested in December, and when it was called after 9 months, they had got a return of at an average at 838% per annum. So they not only got the returns, but they also got their principal back. So this is about the first note that we have got. That was a good return of 38%. It was an income note. Likewise, Barclays had also called one more income note, which comprised of Apple, Amazon, and Tesla. Again, this was as well invested in December 2024. This had given a return of 19%. The third note that was called was from Morgan Stanley. And this was again called after the non-callable period. And as we all know, for income notes or for the growth note, there is a stipulated non-call period, which means that the bank cannot call for that non-callable period. In this case, this was a 3-month non-call period. And after 3 months, so if you see over here, the third note I'm referring to, the Morgan Stanley one, it was issued on June 25th, and exactly 3 months after that, when all the 3 tickers were positive, which is Nvidia, Tesla, and Palantir, the principal was returned. But the good part is till such time, around 7.5% of income was provided to all the investors. So these were the 3 income notes that were called. And the third one, the last one over there, is on the growth note. So growth notes works a little bit differently when compared to the income. So in case of the growth note over here, which was offered by Goldman Sachs, this was the underlying tickers were from Facebook, Netflix, and Google. So here we had 2 scenarios wherein either it will be, if it is called, you get 34% income, and then if not, it will be it will be like a 5x kind of thing. So over here we had 34% income, sorry, the growth that was provided. And again, the clients got not only their principal, but 34% of growth was also provided. So we continue to bring these kind of notes, and there are lots of notes that is being offered, which we will speak in the upcoming slide. Sudhir will be speaking about it. There are 2 income notes, and there are 2 growth notes as well. And most of the time we also try to bring in memory feature in the income notes, which means that if for some reason, if the underlying tickers are below the thresholds, and once it gets caught up, then we will have the previous month's income also being provided. So these are the kind of notes that we try to bring, which we'll speak about it shortly. But just wanted to give a summary of the fact that we have got at least 4 notes called, and so far in this year itself we have got more than 15 notes that were being called. So just a summary of all the notes that were called. And Sudhir, I would like to hand over the remaining part for you to take it up, Sudhir.
Yeah, thank you, Anup, and thank you, Jyoti. So Jyoti, let's go back to the original slide. And Anup, thanks for sharing the information on all the called notes. That shows, the success that we have been having from the notes that we bring to our clients. And today is the right day, to kind of say as to why it's so important to look at some diversification, not only in different sectors of of the market, but also in different structures, right? Because if you look at the structures that that Anup actually shared, most of them are Mag 7 stocks, and Mag 7 stocks are the one that will really have a sell-off. When there is any news like what recently happened, right? On Friday, Donald Trump tweeted about the trade agreement with China and the rare earth contract and all that, and immediately, boom, market is down, 2.7%. And the index is down 2.7%. Now, if you look at each one of these stocks, they are down anywhere between 4 and 10%. So when we bring the structured notes to you, there is usually anywhere between 30 and 50% barriers. So we are covered for that kind of a downside. And usually, for that kind of a downslide to happen, it has to be a real event like COVID or .com burst. So our principle is kind of having some safety, and then you have a good return like 30, 40, 60%. And if you look at all the notes that we did last year, they were all at around 30 to 40%, and even the S&P 500 or Nasdaq 100 did not return that kind of returns, right? So if we are one of those people who would be happy with 30 to 60% return, then putting a decent amount of money in growth notes of these companies, I think makes a lot of sense, because it has the protection and it has a much higher return than what you would get from the index itself. So we will share more notes, as Anup said, after the talk about what happened in the market. So the market was doing extremely well till Friday at around 10 o'clock. Market took a huge nosedive on Friday. That is because of the tweet that came out of Donald Trump's office, that China is trying to impose restrictions on all the rare earth exports, all the lithiums and uraniums and all the materials and metals and stuff that is required for the semiconductor industry and other industries. They are tightening the rules on it. They are saying they are not going to export it to any country, and they want to use it themselves. And then immediately Trump entered and said, look, if you don't sell it, we are going to put 100% tariff on you. Now, what happens if there is 100% tariff on Chinese imports? There is going to be a big problem in terms of inflation. And what happens if the inflation spikes? Fed is not going to lower interest rates. And if interest rates don't come down, all the stocks are going to take a big hit. And that is what happened. Very quickly, the stock market reacted. It fell, 2.4, 2.7%. Nasdaq was down almost 3.8% yesterday. and we touched close to 50-day moving average, which means the average price of the stock market of last 50 days, it went down so much. So if you see the chart, it took us almost 1 week to climb to that level, and within few hours the market really dumped all the stocks, and then it went into that kind of a correction mode. So when these things happen, when it touches the 50-day moving averages, usually what happens, there is usually buy the dip moment. The retail investors are today geared to just buy the dip. So there is going to be buying on Monday morning for sure, is what I feel, a little bit of buying. But then if the institutions and the sophisticated investors decide to continue selling, because there will be a lot more research material and information, insider trading information about what is going on between the two governments, there may be a higher sell-off. Now all of these are driven by catalysts, right? The drop and the pump is driven by the catalysts, and today the catalyst for the drop is this news that is hitting, and the impact of that will be calculated by the smarter companies and institutions, and the retail will get into panic mode and they will sell, and traders will start playing around in the market, same as bots, right? So that is how this market operates. So it's all based on the sentiments of fear and greed. So we think if the market corrects even further, it will give us to put back more money in the market, because a continuously market that is going up is not a good sign, because every month there is a lot of money going from our 401k accounts, from our savings in the equity markets, and if you are continuously putting every month's money into an upgoing market, your dollar cost averaging doesn't work in favor of you. So their market has to be always up and down, and you eventually giving a decent return by end of the year. So this kind of a pullback is actually good for us, because we can put in more money. So if you look at some of our clients who have joined us recently, we have not invested all their money in the market, because we usually don't invest all the money in the market the day they come and sign contracts with us. We usually go slow, because we want to dollar cost average. And one of the large clients that recently signed up, we have kept almost 40% of the money in cash in treasuries, which is earning about 4%, and that we are going to put back in the market. And when it comes to our margin model, we usually take margins when the market is going to go down anywhere between 50 and 100-day moving average. We start putting in more money in the equity market, so we can take advantage of buying the dip as well as dollar cost averaging. So overall, we are not very surprised. I was actually waiting for this correction to happen. I still want more correction to happen. Right now it's around 2.7% correction. I think if we are around 7 to 10% correction overall, we should be feeling very comfortable with the next 3 months worth of upside, because what happens after that correction is more permanent than what happens, which happens very quickly. So it's called support and resistance in technical terms. So we want the support of a very strong inflow in the equity market. That way that money doesn't leave the market like the way it left on Friday. So coming to the government shutdown, right? Government shutdown entered into its 10th day, and the poly market says that it may go up to 40 days. But the probability of it extending beyond 30 days is 30%. So far, when you look at the past, government shutdown history, we have really not seen the impact of that on equity markets. But this time, it is coupled with some of these catalysts, like firing people from government, unemployment going on with private companies. And now this China issue, India issue is lingering still. They have not closed their tariff agreement yet. There are more discussions with other countries as well. So, I think this next 15-20 days is going to be very volatile times. Volatile times is good to put new money in the market and to enter into structured notes, because we can really negotiate very good pricing, from the banks when the markets are volatile. So whatever structured note that we bring between now and next 15 days, I think you have to watch it very carefully, and then try to take advantage of the situation, because when the structure note, the price is finalized, you will end up getting a better price when the market is down, right? So your barrier automatically stands to be much higher than just the 30-50% barrier which the banks would give us. So keeping all of this in mind, I think what has happened on Friday, it is no panic. It is actually good. it is healthy, broadening of market, and the earnings. This is the last point I would like to make on this slide. Earnings are going to start. The banks are going to come up with their earnings on 14th, starting 14th. Wells Fargo, Citibank, Morgan Stanley, JP Morgan, all of them are coming out with their numbers of quarter 3. And the market was actually celebrating, this particular news, on Friday morning. JP Morgan was up almost 2%, but boom, this news comes and market tanks big, and JP Morgan, all of these banks are down. So let's see how the earning goes. I am very bullish about the Q3 earnings and the guidance for future. But you never know. Nobody has a crystal ball. We can only go by what we are reading and what we are researching from the balance sheets and P&Ls of these companies. But I am very positive about November and December, provided this correction continues. Not just 2%, but continues further by around 5 to 10%. Then I think there is no stopping. It is only going up from then on. Next slide, please. Okay, earning growth. I touched on earning growth. The earning growth for Q3 is expected to be around 8%, which is super healthy. And for 2025, for the full year, it's 10.1% and 13.5% for 2026. And overall, it is a good sign. As I said, when the earnings are good, when these kind of news creates FOMO trading and all of that, and the market corrects, 2 to 10%, it's always a good time to put more money in the equity markets. And whatever correction happens, that becomes more permanent and more like a support to the equity markets to pump in further from there. And since we are getting into the year end, most of the institutions which are sitting with cash on the sidelines, thinking that this whole market is full of FOMO bubble, there are a lot of bears in the market, the old timers who don't understand AI, the old timers who don't understand tokenization, the need for AI in US, the Democrats who are not in favor of Trump policies. Now all of that money is sitting on the sideline. Now they have to invest in the market because this year is ending in another 2.5 months. Right now, if they don't invest the money in the market now, their P&L, their profit and loss, balance sheet, brokerage statement, everything will look like crap. So that money has to go in, and that's why we call it a Santa Claus rally in December and early January. So if this correction happens, I feel it is good for our money, which is already in the market. Just don't take steps of getting out so quickly, because it's just 1 day's worth of correction that has taken place. For it to enter into bear market territory, which means there is some real problem in the economy and the market is continuously falling. For that to happen, we need to see at least 10-20% correction. If you look at Liberation Day, we saw a 20% correction, but within one tweet and within one clarity that came from the government about tariff, market immediately picked up and went up almost 65% up from that 20% down. So corrections are always good, earnings are good. Overall, the AI trend is good, tokenization is good, so everything is good. So things are good. So don't panic, be cool, and then we will see how it goes. So equities typically perform very well after Fed cuts. The interest rate cuts are supposed to be 2 for rest of the year and another 2 for next year. And in case there is no recession, and that is what Trump wants, right? Cut interest so that the country does not get into recession, because the companies need to invest money in America, build data centers, build companies. The big beautiful bill has given a lot of stimulus to to companies to invest in America. So more investment comes in the US, more jobs gets created. Otherwise, companies will start laying off. So this interest rate cut is very, very important. And if that happens and the recession has not yet started, which has not been so far because the numbers are not that bad even on the job side, the country's stock markets typically does very well. So the average return, in a non-recessionary environment, and when the Fed starts cutting interest rate, you end up seeing a very, very, very healthy growth in the equity markets, and that is what you see on the chart here. And the orange line shows what if there is recession. And if there is no recession, then that is the red line. You see it going very high and in getting you almost 35-40% return over 2 years and this happened in the past. Next slide, please. Okay, so now the question is, where do we park our money? In always, I have been telling from so many months, years that diversification is the key. We saw gold, silver, doing so well. Gold and silver are the best performing assets today. They have crossed almost 50%, and silver so far has given almost 70% return. And China is buying it heavily because they are trying to de-risk from the dollar. So they are buying. And even gold, if you really see, on Friday, gold was the only asset that was up. Everything else was down. Growth was down, value was down, bonds were down, countries were down. Everything was down except gold and silver, which were really high. And I don't think that will be true for the next couple of weeks, because gold has gone up almost 50, 60, 70%. Same is silver, and same is platinum, palladium, all of these metals. So there may be some correction, because as I always say, 20% of the time market falls. So that 20% has to happen for gold and these metals. So don't be shocked if gold underperforms. But usually when gold underperforms, stocks go up. So something or the other will perform. That is where diversification is the key. And we are seeing, Bitcoin and other cryptos really take a big hit even today. The markets are really selling off because, there is a large whale in Asia who seems to be selling $19 billion worth of cryptos. And again, I don't know what their intent is by selling this Bitcoin, whether to buy gold or whether to enter into stocks, because those investors who are sitting with a lot of cryptos, because the institutions have now started buying cryptos, and those individuals who believed in cryptos, who bought it for very cheap, they are trying to take money off the table by selling them. So, we don't know whether there is some panic. But right now, panic is not clear, because in one day, no panic happens, right? It takes few days, few weeks, few months for clear panic to come out and get surfaced. If you think of COVID, right? COVID actually started in January, but the market fell in April, March end and April. So it took 4 months for COVID to kind of surface, right? Even though there was news, there was all the information coming out, conspiracy theory, US, China, who did it, but the market really took the beating, in March and April. So news kind of starts, but market doesn't react so much unless there is some fraud or some big issue which comes out, like JP Morgan, like Lehman Brothers. What happened with Lehman Brothers? Financial crisis, right? Even that took almost 4 months for it to kind of take the big hit. So gold and silver is a good asset class in the portfolio, and all our portfolios have it. Bitcoin and growth stocks are huge in our portfolio, because we see that to be the future of the world. The growth stocks, like all the hyperscalers, because of the money they carry, the business they have, the earnings they have, and Bitcoin because of its limited supply and the store of value that it is known for. Next slide. Yeah, so this slide basically says the same thing. How do we diversify, where to allocate? So there is no one answer for this. It depends on your risk profile. So we will have to see, what is your need for money? How do we diversify? Where do we diversify? Which country? And it depends on quarter by quarter, because every quarter there is rebalancing that happens. Every month, a lot of macros come out. Every week, macros come out. So it's important to know what your goals are and your investment horizon, and based on that, you need to invest your money accordingly. So just don't go by what your neighbor says or what you read on the news. Just don't go and put all the money in Nvidia, because Nvidia is a great company, but it's such a big company, anything can happen, right? There's so many people involved, so many governments involved, and so much of risk in every other investments that we make. So that is where the only way to feel comfortable with your money, where you can sleep well at night, that your money is safe, is through diversification. Otherwise there is nothing which can give you complete guarantee of certain safety or return. Now coming to what are the macros for next week. Fed Chair Powell speaks on Tuesday. I'm sure he is going to say the same thing, because he is on the way out, but he can sometimes come across as hawkish and can further send a negative signal to the market. Then there is another big news of inflation coming out on October 15th. So as you can see, heavyweights, all heavyweight news, October 14th, 15th, Then there is consumer sentiment through retail sales, and then jobless claims, and then PPI comes, right? Another inflation index. And then there is non-farm payrolls and unemployment rate. So heavy week, lot of news. October 15th is also the final deadline for filing 2024 returns. People will have to pay more taxes, so there'll be more sell-off, because if they want to, if all the money is in the equity markets, and if they have to pay IRS or state, they have to sell those stocks, take the money out. So when all of this leads to selling, it is fun for the equity markets. You will see a lot of red candles. And only thing is, when we know what is going to happen, we don't panic, right? We know that market has gone up too much, it has to come down. All this news is going to be interpreted in several ways, it has to come down. So overall, market is going to be red in my opinion next week until 18th of October, or maybe extended to end of October. But again, the earnings numbers are going to be announced starting 17th. So hopefully, those numbers coming from companies, CEO conversations, conferences, gives a lot of positive news to the market, and the market starts, taking things positively. Next slide, please. Okay, coming to our equity models, S&P was down 2.42 for the week, and Nasdaq was down 2.27 for the week. But for Friday, Nasdaq was down 3.47, because growth stocks are the first to go down when such news come out. Our models are much better because they are very diversified. Our large cap growth model, which is all growth, for the week was 1.51, and for Friday it was 2.86, whereas S&P was 2.7, we were 2.86. So not very different from total growth model being so much, is pretty decent. And if you look at year to date, our large cap growth model on the ETF models, was 18.59, whereas S&P was 12.4. So next generation model, which runs like a horse, falls like anything, that was down 5.49% for Friday. Overall return was still better for the week, but if you look at year to date, they are like more than 3.5 times of S&P 500. Now coming to our individual stock models, very well balanced. It has value, growth, and multiple individual stock models. So if you like the a la carte side of it, you can pick and choose, or we can have a conversation. We can tell you which one is right for you, or we can blend those models and come up with a nice model just for you, which is what we have in custom models. Our custom models, most of our clients are in custom model, first and third line on the right side. That was down 2.19% for the week, while S&P was down 2.42, so we did better. And for the day, we were down 2.69% versus S&P, which is 2.7%. We did a little better. Margin, even though we were in margin in it, we did better than the regular model, because the hedges are much higher, even though we are having a margin. And the growth of the margin model is around 18%, custom model is around 14%. So both of them doing better than S&P 500. So we are adding value, not just in terms of protecting the downside, but we are adding value in terms of generating alpha, which I don't think most of the financial advisors in this country do. So that means we are working hard, guys. We are working hard. Now coming to structured notes, Anup did talk about the notes which were called. We showed you that it makes a lot of sense. It is not too good to be true kind of structures. It does work, and the returns have been really stellar. If you look at this note, this is a note on Google, Nvidia, Tesla. 40% of S&P are in these three companies. So this note is giving you 60% return at the end of year one if all are flat. It doesn't have to be up. As long as they are flat, you get 60%, or if they're not flat, it goes to end of 2.5 years, and you get 5 times of the lowest company's returns. So if Tesla is the lowest company, lowest performing stock in 2.5 years, you get 5x of that return. So solid note, and I think getting a note like this is very hard. So when we have this option, please take advantage of it. This is not in our control sometimes. So 17th October, which is not too far, is the deadline for this. So if you're interested in investing, do let our team know, and put some decent amount of money in it, because the market is down, so you'll get the price of the lower end of the market. So good timing, to invest in a note with 3 solid companies that we trust. Next slide. Okay, so this note is on. This note was created specifically because there was a request from one of the client who believes big time in automobiles companies. So this is a note just on automobile companies: Ford, General Motors, and Tesla. Two old school, one new school. All three companies are solid. S&P 500 large cap stocks. 27.3% income note. You can't get this kind of income, even by giving this money, to one of the best companies in the world, right? If you give a debt to one of the best companies in the world, you can't get 2.27% in today's market, because federal government is thinking of lowering rates, and here we are getting 2.75 per month, and getting this kind of a structured note again is not very easy. So if this is of interest, do let us know. It has a 40% barrier, and it does not have memory, and it does not have 1 star. But the companies, Ford and General Motors are very stable companies. It does not fall that big. Tesla is one company that can fall and grow. Right now, Elon Musk focusing on Tesla gives you confidence that it should grow. They're coming up with a lot of new ideas. We are seeing a lot of news coming from Tesla. It's coming almost back to the all-time high. So hopefully, Tesla is going to do very well in the next 2 years. And this note can be called. This note can be called within month 3. So if it gets called, then you make 2.27% per month for 3 months. And if any one of the stock is down, it is good for the note because it keeps going till it comes back up. So so overall, good note if you are interested in automobile industry and you like these stocks. Next slide, please. This note is on Palantir, Tesla, and Nvidia. Again, big names, same kind of names. October 24th is the date. And this has 1 star, which means if just one of the companies is flat or positive, you get your money back. There is no loss of capital at the end of year 3. And memory feature is there. So if the companies go down on a month-on-month basis and then comes back up the next month, you get paid the returns. And when you have these two features included in the note, returns will not be in the 20 or 30% range. Right now, this note is a 19% income note. So good note. Again, with this kind of protection, we have 2 additional protections, which is 1 star and memory. So 40% downside, good companies, and the 1 star really protects it big time. That's why the returns are not in the 20%, as I said. The next note is on Bitcoin and gold. Some of my clients, they don't trust Bitcoin because they think it is virtual, it is volatile. You try to explain them that it is a store of value, it has limited supply, even though it's virtual. Everything is, a lot of things are virtual in this world today. Internet is virtual, blockchain, all the technologies are virtual, but sometimes you can't convince certain people, and they wanted a note created with the downside protection. So we created a note with Bitcoin and gold. So one is both are store of value, both are long-term assets, and one is correlated to growth like S&P 500 stocks, like tech stocks. And gold is when S&P falls, you have gold to kind of hedge. So this is a 3-year note, and it can be called in 1 year. So at the end of 1 year, if it gets called, you make 30%, or you make 30% in year 2 if it is not flat or positive. So it kind of we have a quarterly look up here. So every quarter after 1 year, if it is not flat, we see it, and then you get 7.5% per quarter, which finally translates to the same. So a good note for diversification. So if you are putting, let's say if you ask me the question, I have $1 million, how do I invest? I would say let's spread the first half in the first 4, and this note, which is gold and Bitcoin, maybe 25% of the money in this. That way it's diversified portfolio of structured notes in multiple asset classes. Next slide. Okay, so Jyoti, if you can go to the MTP website very quickly. So we have multiple funds. We discussed about this last time in our last webinar. So we have our website mytimeequitype.com. My time equity P is actually my time equity private equity. So this is not the RIA. This is not my time equity. It's a second company where we do our own deals. We bring our own offerings. So if you look at the offerings here, the first one is the tax efficient income and growth fund, which we call MTI. So if you click on this button, Jyoti, if you can click on that button, it goes to the invest page. And from here, you can directly, express your interest on how much you want to invest. And you can read through, what does the fund mean? What does it do? So this fund is a very tax benefiting fund. The very short formula here is if you invest $100,000, you can write off almost $220,000 in year one in 2025. Then you get 4% cash on cash paid on a quarterly basis. And the total return in 5 to 6 years is 1.6 times of your capital. So very good diversified strategy. We have money invested in all these things that we talked, which is, plant, machinery, real estate, car washes, cattle, livestock, and stocks, structured notes. All of the investment will be made in this. So if you are one of them who sometimes my clients come to me and they say, hey, you bring so many opportunities, we are confused, we don't know where to invest. So this might be the answer for that, right? Because it has investments in all. Not only that, it gives you a big write-off in 2025. So if you invest 100K and you can write off 220K, if you are in a 37% tax bracket, then you are saving almost 100K from taxes. So your investment is kind of coming free, right? That is how we have structured this. So you can get the tax benefit and you can get income, like how you get paid on treasuries. We are expecting around 4 to 6%, but to be on the conservative side, we are saying 4. And it will be paid on quarterly basis. And then there is return of capital with overall growth of around 6.66. So that means if you put 100K, at the end of return, you'll get about 160K. So with the tax benefit and all that. So go back to the offering page, Jyoti. Yeah. So if you go to the next offering, you can look at our second offering, which is investment in pre-IPO companies. You have offering in Databricks. Click on that, Jyoti. You have offerings in Databricks, and then Vercel, OpenAI. So you can choose, where you want to invest your money out of these 5 companies, and then express your interest with the amount of money you want to put in each of these companies. Click learn more. So when you click on this, you need to enter your details and then enter the desired amount, and then you can see all the details like the documents and things like that. Go back to offerings. Yeah. So the third fund that we have here, I'm sharing this with you. We have discussed some of these funds in the previous webinar, but now we are putting all of this on one page. So this is our digital asset fund. Scroll down further. And then we have our Tiffany Green home fund. We are buying these 20 lots, which I shared this 2 weeks ago. So this fund is almost completely full. But if you're interested, you can express interest, and if somebody drops out, we can offer that to you. Go down further, please. Then we have XAI and Perplexity. XAI is already gone. Perplexity may be available. So again, play around with this. Look at the website, look at all the offerings, and these are offerings that we do. It's managed by us, controlled by us. So while we have other sponsors that we bring out, car washes and oil and gas and all those investments, this page, this website only lists our own offerings, which are managed by me and my team. So do let us know if there is interest in this. So go back to the PPT. So now I think we can take questions. And folks, if you have not joined our WhatsApp group, if this is your first webinar that you're attending, please join our WhatsApp group, and you will get a lot of information there, about our companies.
Thank you, Sudhir, for briefing on the interesting market that we had this week, and also about the comment shutdown and the 4 structured notes, as well as the offerings through My Time Equity PE, which includes MTI fund and crypto and pre-IPOs and cancer opportunity in Kansas. Thanks for that. There are a couple of questions so far that I see. First is, what is your take on the market going into recession in 2026?
Yeah, that's a great question. See, if you look at the long-term charts and cycles of the world, right? So there is a long-term cycle chart that has been put by like 200 years ago. That chart shows that 2026 is going to be a major correction year for the equity markets. Now, recession is, recession, there is a formula for recession, which means for 2 quarters, the country should not be growing. Continuously 2 quarters, it should not grow. So we are seeing GDP growth currently, and we are seeing the Fed taking interest in lowering the interest rate. So if interest rate goes down and if companies perform, then GDP is not going to go down, right? But consumer sentiment, so there is a difference between GDP and there is a difference between equity markets, right? And there is a difference between recession and then the equity market. The problem with the world recession is the market will really take a beating because emotionally people really get into negative sentiment, and recession is the catalyst for market to drop big, because that is what has happened in the past. There is immediately sell off, and market can see anywhere between 30 to 60% downside risk, right? And that is why we come up with the 30 to 50% barriers on our structured notes to protect our money from even a recessionary kind of environment. But then you can't protect everything. We don't know, because if you really look at the long-term charts, we have seen that kind of correction happen only like 3 times in the last 20 years, right? One was the dot-com burst, one was the financial crisis, and then COVID. And then Liberation Day was a created one because of the tweet and then misinterpretation. So market wants some news for it to drop, right? So coming to recession, I think there is going to be a big correction in the market. The word recession may not be there because from last 4 years we have not seen a nationwide recession. We have seen sector-wise recession. When I say sector-wise, if you look at real estate, it has been down from the last 3 years, because since interest rates started going up, real estate has been sleeping. But if you look at equity markets, the reason why it is up, that too only the large companies which really don't care about interest rate are the tech-heavy hyperscalers. So only those are going up, others are not. Now, once the interest rate cut happens, then we should see others taking off. So I think, again, this is my personal opinion. I think between now and mid of next year or the 3rd quarter of next year, we should not really be seeing a whole lot of bigger corrections. It could be anywhere up to 20%, but not bigger than 20%. But if earnings go bad, if there are companies coming out and saying, hey, this AI, we are not able to monetize, we are spending all this money, but clients are not willing to pay. If there is a problem with the earnings, that is when I think we are going to see a huge challenge. And if Trump is not able to put pressure on the federal government to lower interest rates, that is going to be a big problem. And interest rates and inflation is connected, and inflation and tariff are connected. So, so it's kind of very complicated situation right now. And on top of all of this, you have your geopolitical tensions, right? Of oil price and, rare earth, all of that. So very, very difficult environment, lot of volatility, but still, equity markets have been doing well. You can't take your money and convert it to illiquid assets and then expect it to generate 30% return, because it's very hard to get return because every other asset is super inflated. But whether the inflated asset will kind of be okay as the time goes, is what we have to wait and watch and be active with our money. We should be able to take actions very quickly, quarter on quarter basis. That's the long answer to the short question. Now, next question, I can take it, Anup, for the MTI income note. How can I prove that I'm active investors? I did answer this question a few times in the previous webinar too. Now, your active investor status depends on how much time you put and what is your current employment status of you and your spouse. It's a longer conversation. You'll have to get on a one-on-one consultation. This is more of a tax consultation. So if you can talk to your CPA and get answer, that would be best. Because while I am a CPA, I am not practicing tax any longer, because managing this equity market structured note and this company and all this offering itself is, a 3-day job in a day's time. But happy to answer any questions, but not as a professional, unless you are willing to pay a consulting fee to me to become a CPA for a few hours and give you the answer. But my request is you talk to your own CPA and get the answer for your active participation, because there are a lot of conditions to be followed, and you will have to check with them to see if you follow those conditions. Can you give an update on SMK Strategic Land Fund? So all the land funds are doing extremely well, because the purchase of those lands were done at the right time. Again, opportunistic purchase, a good timing, and it's all doing very well. Now, the only 2 assets that are a little bit under pressure, one is the Arlington building that we bought. We have some amount of vacancy there. The Concord Sherman building that we bought, we are having a lot more repair bills come up there. And then 2 medical buildings that we bought in Michigan, the tenant has left and we are still trying to find tenants for it. So those are the 4 assets that are a little bit under stress. But again, real estate is usually, real estate is real, and it's hard asset. So hopefully, we'll be able to get out of these concerns. Again, we are waiting for that interest rate cut to happen, because once interest rate cut happens, companies will start buying buildings, occupying properties as tenants, and things will change. So let's see how it goes. We are positive about the market, and so far our positivity has only given us the right answer so far. I heard about 351 opportunities. Can you elaborate? Yes, we do have 351 opportunities, which means if you have a lot of stock which are concentrated positions, we have an ETF. You can merge all your stock into that ETF without paying any taxes, and you get the shares of that ETF in exchange for all the stocks that you have in your portfolio. Now we need to have at least 4 stocks to merge with the ETF. And this ETF is getting launched by 21st December, and we have to get a list of all your stocks that you want to merge, by November mid, and then the stocks will be accepted. The ETF has to accept it, and then the merger happens, and you will see the ETF in your brokerage account versus multiple stocks which you don't want to carry or don't want to pay taxes on. So great opportunity for somebody who wants to diversify from their max 7 positions, or from their multiple stock positions, or multiple crowded brokerage account that they want to kind of simplify. We can use this model to kind of bring everything together. And now we can offer you help there. We can review all your stocks. We can see what makes sense in terms of merging with the ETFs. Now, for doing all of this work, there is a fee that we charge. So if you're interested, please send an email to wealth@mytimeequity.com. It's going to be about $250 million ETF that we are launching, and there is going to be approval from the ETF manager that we have to get. So if you are interested in diversifying your overall portfolio, do let us know. Happy to help. Any view on precious metals like gold and silver? Precious metals are doing very well. We have seen between 50 and 200% return between gold, silver, platinum, palladium, and other metals. Even the S&P's metal ETF is up by almost 40%. So overall returns on metal so far has been good. But as I always say, long term the trend is very good. Short term we may see some consolidation, because if the equity market goes up and there is selling by any of the countries of gold, like what happened with Bitcoin, right? Bitcoin yesterday, almost 150K Bitcoins got sold, and immediately we saw Bitcoin taking a big plunge. But usually what goes down comes up. So, if you're looking at trading on a daily basis, I am not the right guy to give you solutions. But if you're looking at long-term trend of gold and silver, it is pretty good. And that is why we bring the structured note, right? We brought the structured note with gold for a 3-year note, because we are positive about gold, we are positive about Bitcoin. So I am very positive about every other asset class except bonds, and some of the companies which are in very big bubble stage, right? We don't touch meme stocks, we don't touch meme coins, because the risk is too high. You don't know what's going on. So every other asset otherwise I think will do well in the long run. Long run is defined as up to 3 years. Any chances of market correction happening in 2026 high? We don't know, right? There, as I said, the cycles show that 2026 might be a big correction year. But again, we watch our portfolios on a daily basis. We see, like I showed you the chart. The chart shows that market touched the 50-day moving average. If it touches 100-day, 200-day, we take actions. If it goes below 200-day, we take more action. So we are watching the market on a daily basis. We just don't put money in the market and leave it to God. So we do take action. Sometimes taking action is beneficial, sometimes it is not. But we do what we think is the right thing to protect our capital, right? So that is how it was. Is there a cutoff date to participate in MTE tax efficient fund? Yeah, the cutoff is going to be December, Christmas time. You can invest money in the fund as of up to that date, because this fund will be, it's created only for 25. Next year again we'll create a new fund, but the benefit that you get on the tax side is only going to be for 25 through this fund. So the second fund will be for next year, but you have time. But again, the problem that we have is if you invested the last minute, how we will have to invest in real estate and other things. So if you are really trying to take advantage of this fund, because assets are very expensive these days, and finding good assets is very hard. Like we found that Raceway car wash in Plano. It is on the intersection of George Bush and K Avenue. Beautiful gas station on the highway itself, and Sarvanapavan is close to it. A lot of Indians live close to it. So a lot of our clients could connect to that car wash. We are closing on that car wash in a couple of days. But that car wash was not as low cost as last year. Last year we could have bought it for much lower. This year the prices have gone up because the big beautiful bill and the inflation and asset prices are going up, right? Because nobody wants to keep money in bank account. That's the most stupid things you can do. Dumbest thing you can do is keep money in your bank account without investing, particularly the long-term money that you really don't want for the next 12 months. You don't want to keep it in your bank account and let it kind of give you a 4% return, right? It is better you invest it, because markets go up and down, and the long-term trend seems to be very positive right now, as I explained in all the slides. So be positive, guys, and talk to us if you have questions. Happy to have one-on-one conversations. Next week we'll again come back at 11 a.m. Central. And till such time, thank you very much. Hopefully next week the market will not be as red as what I think it will be, but let's be positive. Thanks a lot, Anup. Thanks a lot, Jyoti, and see you all next week.
Thank you,
Take care.
Sudhir. Thank you all.
Thank you.